I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. Some of the most frequently asked questions right now is, are we at the bottom? When will we hit the bottom? Oh yeah, I get these questions all the time. The short answer is no. See, I just saved you a lot of time watching this video. But I think you should do better watching the whole video and find out why I think so.
Rock, meet, bottom.
I'm not really into market timing, and especially in times like these where everything is getting hammered. I have my buy list ready and I have already calculated the entry price for the companies I'm looking into, so I buy when they hit that target price, no matter what. I recommend you always have your greatest companies calculated for the fair price you're willing to pay, so you don't get to feel FOMO or panic in any way. I use my stock tracker for this, and I have set some alerts for each of the companies I would like to own, and when it tells me to, then I'm buying. The last couple of days my alarms have been going off like crazy, and I have deployed most of my cash at this point. I know, maybe a little bit too early. As usual, I was premature. I was a little quick. I pulled the trigger too soon.
Too early, Dom.
Still a bus in.
When these types of corrections, crashes occur, I usually will take money from my savings account. I usually have around 2% of my portfolio in cash, and then I deploy it in 3 to 4, maybe 5 buys, dollar cost averaging down. However, I have no specific timing for this. Remember, I already have the buy price, so I know what my starting point should be. Let's look at Tesla. When it reached 764, I bought with 25% of my cash, and I didn't think it would go any lower, but it all of a sudden went down to 667. I bought again, this time with 50% because it couldn't go any lower. Then I felt really lucky, and only time will tell, that I had a buy again at 634. However, this time I did not have very much cash left, so I had to sell some of my Google position at a loss actually, just to buy the last round of Tesla. That's how much I believe in Tesla. I know my Tesla discounted cash flow model. I have a 90% certainty that it will reach at least 3,000 in 2030, maybe even 5,000. And if FSD goes live and it goes well, maybe even Tesla bot, it's at least 4x. So buying Tesla at under 700 is a great bargain. But will Tesla go lower? Will the market go lower? Are we at the bottom? I really don't know for sure, and actually I really don't care either. I have bought my great companies, and I'm just trying to save up some more money so I can buy more before this sale ends. Everybody's talking recession and crash and such, and interest rates, and oh my god, macro. I call it sale. I know what my companies are worth, I know what I want to pay for them, and if I can get them at that price, I'm happy. I don't need the money in around 15 years, so I really don't care if we have a 12-month slump or maybe longer. It just gives me more time to buy more stocks. Take a second to think about this. This sell-off we're seeing, and people panicking, has anything changed in the companies you own? Well, really changed the fundamentals? I have Tesla, Microsoft, Google, Pepsi. Their financials haven't really changed that much.
I can go through the line items of this past quarter, which largely were in line. 18.3 billion for intelligent cloud. Of course, people always focus closely on that. That was in line. Productivity and business processes was 15.9 billion. That was in line. And then the beat on the revenue line, personal computing, came in at 17.4 billion. The forecast was for 16.5. That explains the revenue beat for the quarter just passed. And as we said already, the EPS was a beat there as well.
And I know the valuations before the drop were a bit crazy, but hey, all levels were there. Where we are now, we're at decent levels. Some of these companies could even be called a bargain. Yes, I know your argument. A recession will kill their revenue and earnings. True, but I really don't believe we're going to see that type of recession that we saw back in the 30s, 1930s that is. For one, unemployment is really not a problem. There's still a labor shortage after the 2020 lockdowns and work from home, etc. Consumers have plenty of money thanks to past earnings and the stimulus payments and the extra unemployment insurance. Business has plenty of cash too. Not only have profits been good, but the Paycheck Protection Program gave nearly $800 billion to businesses. Companies want to buy computers, software, solutions to substitute for the workers they cannot find, and this spending will help manufacturers of the equipment and so on. So it seems all these problems we see in the market are just because of too much money pumped into the system and problems with supply. So too much demand, too little supply. Did the Fed do a little boo-boo? Yeah, I believe so, but more on that later.
What happened? Over the last couple of years, we had $10 trillion of money printing, right? Why did they do that? They thought that they could stimulate our way out of this COVID recession that they had induced with lockdowns. In any event, the point is they thought they could stimulate economic activity by printing money, and maybe cynically, politically, they thought it would be good for them in the midterms. What actually happened? That 10 trillion goes into the economy, but there's no corresponding increase in the output of goods and services. So two things happen. First, price levels rise and we get inflation. And second, we get an asset bubble in the stock market. And then the way both those things sort of come crashing down to earth is the Fed looks at this inflation and suddenly has to jack up interest rates. That pops the asset bubble. It vaporizes something like 14% of global wealth. And then simultaneously, workers feel a lot poorer because their wages haven't kept up with inflation. So this whole idea that you can just print money as a way to create wealth and prosperity, I hope what we take away from this, I think, recession that we're going into is that is not a viable strategy. The only thing that creates wealth in a society is the output of goods and services that people want. And you just can't try to sort of play games with that by creating this sort of phantom money that doesn't represent a real increase in goods, services, or productivity.
Yeah. Let's just get our heads around the basics. The classic definition of a recession is 2 calendar quarters with negative GDP. The first quarter of 2022 saw GDP fall by around 1.4%, so that's a check. If second quarter also is negative, then we are in a recession. I estimate the chance of that being fairly high, but please remember, a recession does not equal a complete meltdown in the market. We actually had a recession back in the beginning of 2020, but no one really noticed it so much because it didn't last that long. The Fed announced it would raise interest rates at each of its meetings, but let's see, it would be data dependent. I think Papa Paul is testing to see how much markets and the economy reacts and what's going to happen. Then he's going to raise rates, or maybe not. Well, we know the reaction has been very, very negative so far. Everybody's fearful because they know that Papa Paul or the Fed won't backstop everything, so they're kind of in new territory. Therefore, I wouldn't look for the Fed to raise rates as much as previously stated. Let's just see what happens. Stocks will likely continue to struggle over the next 6, 8, maybe 12 months or longer. And you should be cautious what to buy. And I hope people learned about those speculative companies. And that's not a viable strategy when the market goes down. But please remember, markets fall, markets rise. The main question is, how long will this current condition persist? If we look at the decades of research there has been, this too will pass. That's why timing is so crucial. Not timing the market, but timing your investment versus your timeline, and thus creating your strategy. If you're young and just starting out, you can easily be invested in growth companies. Maybe they're 10x or not, you have enough time to recover. If you're a little frugal with your spending, you should be able to invest around, let's say, $500 or maybe $1,000 every month. Let's say you have 10,000 invested and lose it all, it will only take you around 1 year to get it back. But if you have been investing in 30 years and have millions invested, losing 50% can be difficult to get back in within your time frame. meaning you need to be a little bit more careful the longer you have invested and the shorter your timeline is. Well, as you know, it's impossible to know exactly where the bottom is, as the bottom of the S&P 500 might not be the bottom of the Nasdaq, and definitely not the bottom of individual stocks. Are we at the bottom? So, the question, or should I say the answer, is really not very useful unless you're looking at some specific companies and know their fair value. Take a look at my video about how to value stocks, link in the description. There I have included a link to an Excel template where you can use it to value a company using discounted cash flow. But let's assume we're talking about the market in general. So we need to take a look at some of the indicators that we know. I always start with the VIX. It's a CBOE volatility index. The VIX is commonly called the fear indicator because it represents the expectations in the market over the next 30 days. The VIX measures the magnitude of price movement in the S&P 500. The more dramatic the moves are, the higher the level of volatility. Usually when investors are selling everything that isn't nailed to the floor, the VIX will spike. However, if we look at the VIX right now, it has not had any significant spike yet. Look at the chart and see that the spike back in March 2020? We're not there. Yes, the market is very choppy, but it does not really seem to have peaked yet. The VIX is still between 20 to 35, and it should go a lot higher for an indication of where we are at the bottom. So the first indicator says no, we're not at the bottom yet. The fear and greed index tells us a lot. It tells us the sentiment in the market and where it is and where it could go. I think it was 14 days ago we were down at a 6, which is quite low. And at the time of making this video we are around 12. Which is still in extreme fear, but not as low as 6. Well, how is this calculated? The Fear and Greed Index consists of 7 indicators. Market momentum, the S&P 500 versus its 125-day moving average. If movement is slowing, it shows us investors are not buying as much as before. Stock price strength. This indicator shows us the number of stocks on the New York Stock Exchange that have a 52-week high compared to those at the 52-week lows. When there are more lows than highs, this signals fear. Looking at market momentum, you can see we're on the way up again. Well, looking at stock price strength, you can see a tiny tick up, and maybe it'll continue to go up, or maybe it's just a small rally and we will come down again. The next one is stock price breadth. This one looks at the volume of stocks being traded on any given day. It looks at the amount of shares that are rising and falling. If trading decreases, this signals fear. And this is very much signaling fear. It seems like there are no buyers anymore. Put and call options. Puts are an option to sell, calls are an option to buy. When the 5-day put to call ratio is rising, this usually signals fear. More people are betting the stocks will go lower. Right now we are seeing surprisingly low put to call ratio. Typical when it spikes above 135, it's a good indicator that the S&P 500 is at the bottom. And funny enough, we're on the way down. So, maybe people are not just as fearful as I thought, or we're just seeing a small rally. Market volatility, the VIX, I mentioned that before. The VIX is also a part of the Fear and Greed Index. However, here it's represented in a comparison of the VIX and its 50-day moving average, so we can determine the direction and if we're headed up or down. And I'm kind of seeing a downward trend here. Not at the bottom, but downward trend. So again, not at the bottom. Safe haven demand. Usually there will be a shift into bonds when investors are afraid of the volatility. This indicator shows us the difference between treasury bonds and stock returns over the past 20 days. When bonds are doing better, that usually means investors are scared. And what does it look to you? It looks like it was down and it's slightly climbing up. The seventh indicator, junk bond demand. This is the difference, the spread between junk bonds versus investment grade bonds. When investors buy junk bonds, the yields drop and vice versa. A wider spread shows us that investors are not willing to take more risk and are looking for safe havens. All of these indicators combined give us the level of fear and greed in the market right now. And even though the Fear and Greed Index is in the extreme fear area, we're definitely not in the real low numbers. Remember, we were down at a 6. We can also look at the S&P 500 PE ratio. It's historically dropped below 15 when it's really, really bad. Back in 2018, it went to 14. And in the COVID crash in 2020, it actually went below 14. This tells us that the market hasn't seen that moment where everybody is running for the exit. So it would be a good guess that we need to go lower. We really don't know what's going to happen and when this occurs, as the Fed has not made it clear if they will return with quantitative easing again. I think the Fed is balancing on a knife's edge, and in the coming months and maybe even a year, we're going to see a very choppy market. I know a lot of people are talking about high inflation, and that's sort of true, but I don't think the inflation we're looking at, around 8% now and going down, it does not have to hit all sectors at the same time with the same force. Though a lot of companies just raise prices just because they can and blaming it on the supply shortage and the increase in fuel prices, every company is not the same. And it also looks like inflation is going down again, and I'm one of the believers that this inflation will not last as long, maybe a year, at least at these levels. However, it seems like we're in the middle of the perfect storm. What is inflation actually? I think David Sachs from the All In podcasts puts it very well. It's too much money chasing too little goods. Usually I would say that inflation could be categorized in three categories: a demand pull effect, a cost push effect, or the built-in inflation. The demand pull inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services, and it does so more rapidly than the economy's production capacity. This increases demand and leads to price raises. Sounds familiar? The stimulus checks being forked over and created a spending spree, and all of a sudden, demand was a problem? Cost push inflation is the result of the increase in price working through the production process. When additions to the supply of money and credit are channeled into a commodity or other asset, especially when this is accompanied by a negative economic shock to the supply of key commodities, costs for all kinds of intermediate goods rise. This seems to be the case right now with extremely high oil prices, and the production shortage is still lingering from the lockdowns and maybe even getting a little worse in the near term. Built-in inflation. Built-in inflation is related to adaptive expectations, the idea that people expect current inflation rates to continue in the future, and thus the rise of price on goods and services. Workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs, wages, money to maintain their standard of living. Their increased wages results in a higher cost of goods and services, and this wage price spiral continues as one factor induces the other and vice versa. We're into a death spiral. The Consumer Price Index is a measure of the average change over time in prices paid by the consumer. Indexes are available for the US and various geographic areas, and average price data for selected utility, automotive, fuel, food items are also available. We can also look at the 10-year yield curve versus the 2-year, but it seems that this measure is not a very good indicator anymore. Some will still say that the 10-year yield curve signals the coming of a recession, but it's very, very hard to say. I'm expecting to see the same as from 2019 to 2020, a choppy market, but slowly rising again in 2023. Let's look at the unemployment. As you can see, it seems like the unemployment rate can signal the correction, the crashes, although it's a lagging indicator, and that makes sense as people start getting fired when the hard times begin, so that's when companies fire. We are seeing this beginning right now. A lot of companies are looking to increase profits and secure themselves, and they're laying off essential workers. But still, the numbers are not signaling real problems. The Buffett indicator. The Buffett indicator is used to assess if the market is under or overvalued. The Buffett indicator is the ratio of total US stock market valuation to GDP. As of May 23, we calculate the Buffett indicator as the market value around 39.3 trillion, annualized GDP at around 24.4 trillions. That means 39.3 divided by 24.4 equals 161.1%. That's about 29% above the historical average. So we are not really in a complete overvalue market anymore, but we're definitely not at the bottom either. Again, the data suggests that we need to come lower. We talked about the wages before, and as I mentioned, the inflation in the wages are going up. Notice the bump in 2020, where a lot of people didn't want to return to work. I hope we will see a decline in the wages again. And basically, it looks like I'm right, but we're not sure yet. We are seeing layoffs, and usually that's a sign that we're around the bottom. But we still need to see some significant more layoffs to be at the true bottom. The housing market. We have seen a slowdown in sales, mostly because everyone thought they could charge crazy prices for their homes. But demand is still fairly high. But they just don't want to pay any price anymore in this environment. There is time working against us, as there's a lot of millennials starting to come out and become first-time buyers. In a few years, Gen Z will come to market, and when they start hitting 30, and as a lot of these have more money than their parents had, I don't see a huge declining housing prices, and actually maybe a little problem. The next 10 years of demand will be higher than the supply. Maybe we should invest in some like Toll Brothers, some others building houses? Might be a good idea. We could also look at manufacturing and commodities. I also look at the Shiller PE, also known as the CAPE ratio, cyclically adjusted price to earnings ratio, as it uses real earnings per share over a 10-year period. Right now, the Shiller PE tells us it's at 32.40, and the mean is almost 17, and the median is 16, so we are way too high still. The S&P 500 PE uses trailing 12 months of earnings. As we can see, it's around 21, and the mean is almost 16, and the median is still around 15. So we should be able to come down some more. If a real recession hits, we could go below 15, maybe 14, as I mentioned earlier. But I don't think that will happen. Now, we have looked at a lot of different indicators, and my overall assessment is we are not at the bottom yet. And I'm afraid we're going to see a little dead cat bounce, small rally coming up before summer. But we are going to go lower. I am quite convinced of that. As I mentioned before, the S&P 500 is still not below its highs in January 2020, and neither is the Nasdaq. I'm not saying they need to be, but they should not be as high as they are. I will predict the bottom of around 140, 145 for the Nasdaq, and around 3,500, 3,800 for the S&P. So we need to go around, 15, 17% lower? Well, let's hear it from the expert from my favorite part, the All In podcast.
The bouncing along the bottom, I think, is how we'd all describe what's happening right now.
Well, I think, listen, what makes investing hard is sometimes you have to hold simultaneous truths, right? And the reality is there's a lot of cognitive dissonance when you see something down 30, 40, 50%, but it may be still fair value, right? The market last October had gone too high. We discussed it on this pod. We discussed it on CNBC. And so I expected a return to what we call the 5-year average, as we discussed at the summit. I don't think it's helpful to say, well, none of that should have happened. No, the reality is normalization meant that all of this stuff was going to be down 20 to 50% because it was way overvalued last fall. We gaslighted ourselves in many respects. We didn't hedge it perfectly in many respects. But that's what happens in late market cycles.
There's going to be 2 50-point hikes, one in June and one in July, and then effectively a pause, because then the Fed funds rate will be at around 2%, and everything from there will probably be path and data dependent. Okay, that's effectively what they said. Now, I think the markets had actually already started to see that writing on the wall. So if you go back to one of our favorite measures, which is the 10-year break even, it's effectively rolled over, which means that from the highs in sort of late April, it started to come down, which says that, they were thinking that, the inflation was not going to be as bad in the back half of the year. So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable? Or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again? And we're not going to know, although tomorrow on Friday, there's going to be a really important set of inflation data that gets released. And I think everybody's going to be sweating these details. So right now we're in a moment of pause. And there is the potential, if this data comes back as reasonably good, which means prices are, not escalating as much as we thought, inflation is not going to be as bad, growth is going to be moderate, that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom.
So basically, I would say we need to go further down to be a real buy now moment. I have been nibbling, and I will be buying my favorite companies when I get more money. As we can't time the market, we need to invest whenever we can. And I have done my analysis on my companies, so I know what the fair price is, and we are there. So I'm going buying every month I can. And as always, the best investment you can make is in you. The more you learn, the more you earn. If you found some value in this, I hope you will give this video a like, maybe even subscribe to the channel and help me out a lot. And on that note, I will leave you for today. Have a nice one. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting.